Right, good morning everyone, and thank you very much for joining us. This is a Norden's Chartered Accountants webinar. My name is Michael Sharp, and I'm also known as the Financial GP. I'm also a Chartered Financial Planner. I was kindly asked to co-host this session, and of course I accepted at once as I'm really passionate about this subject. And I've spent my entire career helping professionals and families take control of their financial future with clarity and confidence. Over to you, Lorraine.
Hi, I'm Lorraine Curtis. I'm the Director and Head of Norden's here at Head of Audit, here at Norden's. I support clients including charities, solicitors, FCA regulated firms, subsidiaries of listed groups and much more in both the UK and abroad. I'm delighted to be co-hosting this session with Michael alongside my colleague Elizabeth Bello, our tax manager.
Thank you, Lorraine. Hello, everyone. I'm Elizabeth Bello and I lead the tax department at Norden's. I focus on compliance and advisory services, working with individuals, businesses, and high net worth individuals, so clients. My role is to ensure our clients get a clear and efficient strategy that aligns with their wider goals.
Yes. For those of you who may be new to us, I'd like to share what drives Norden's as a firm. Our purpose is very simple. Through innovation and inspiration, we aim to redefine the industry and elevate business excellence. Everything that we do is about going beyond the numbers to create a more meaningful impact for our clients.
And with that in mind, before we start diving into the details, I just wanted to ask you a quick question to get us started. So, do you ever feel like you're saving less than you should whilst also being on a high salary? If you can please give us just a reaction using the links at the top or let us know in the chat. Yep, I see a few hands up there. That's good. Okay. So if you've said yes, and a few of you had, you're not alone. And just to confirm as well, when we say high earners, we're meaning those that earn 100k or more here, which on paper, of course, this looks comfortable. Yet the reality is it comes with high tax burdens, of course, and therefore more complicated financial decisions.
For families, the pressure is even greater. September is the month when many families reassess their budgets. I myself have experienced that this September. My eldest one has moved away from nursery and into school. Whilst I initially celebrated saving on the nursery fees, I've suddenly become aware of changing my childcare arrangements, before school club costs, after school club costs, school uniforms, rising bills, and suddenly a six-figure salary just feels like it's completely stretched.
So to give you an example, a household earning, say, 120k, you can easily lose access to your child benefit allowance there if you're claiming it. And this is because your adjusted net income is over the 100k mark. You add in, say, nursery fees of, it's easily another mortgage in some cases, maybe
I know that
1,200 quid. I know the feeling as well. Yeah, I had two in nursery at the same time. So you got, of course, uniform, mortgage payments, pensions, uniforms for children. Cash flow becomes easily a big juggling act. You might be a one-parent family who's self-employed, unpredictable income, and you throw in high childcare costs. You can easily get tax concerns in these scenarios. So we understand where a lot of you are at the moment. Over to you, Lorraine.
So that's why today's webinar is going to go beyond theory, and together we're going to look at practical tax planning strategies, how you can reduce your net income to keep access to benefits that are available to you, investment and wealth building options, cash flow management for families, and protection to safeguard your income and assets. And with that, I'll now hand over to Elizabeth, who's going to start us off with some tax planning.
And just before I start, if anyone has any questions, feel free to raise a hand or give a little reaction, and then you could ask your question. But tax planning. So tax planning is the foundation of financial success. It's about being proactive and not reactive. Small steps can make a huge difference. For example, contributing more into pensions reduces higher tax rates and builds long-term savings. I'll give you an example, a client who I'll call Sarah for the purposes of this webinar. So Sarah earns 70K a year and she's in the higher tax rate threshold, which means her income that's just above a little above 50K is taxed at 40%. And she wants to start planning towards her future. As it stands, she has about 20K being taxed at 40% but with pension contributions, she can contribute about 10K of her gross annual salary into her pension pot. So she will only have 10K taxed at 40% and the other 10K into her pension pot. So she's invested into her future savings and given her the opportunity to be taxed at 40%, but a lower income than what she would have been taxed if she didn't make any future investments. Other vehicles is ISAs. A lot of us, maybe we have ISAs, but we don't utilize them. ISAs let you grow up to £20,000 a year tax-free. So another example is, let's say you put 10K in stocks and shares ISAs and it grows to £12,000. With a normal investment account, you might pay tax on a 2K profit. In an ISA, you actually pay zero tax. So that 2K profit is actually yours. And then, of course, there's the simple allowances such as marriage allowance, personal savings allowance. So the hidden allowances that we don't sometimes know about because they're hidden. But that's where I come in. Someone like myself will help you find that and then utilize that for your benefit. Another tax I've been talking to quite a few of my clients about recently is inheritance tax, a conversation Michael and I have been having quite frequently as well.
Mm-hmm.
This is important.
Yeah. I mean, it's something I think that quite often is driven by the children. It's not always you thinking about your own inheritance tax liabilities. That might be quite some distance away. And ultimately, in terms of your parents, if you look at it in a certain way, it's you're the one that's going to be paying it. I mean, yes, it's them, it's their estate, but you're the one that's not going to be getting the money, even though it's them that can make the decision to plan for it themselves. So I would say definitely, if you haven't already started to have those chats with your parents, and of course we've got a budget coming up quite soon, I would say maybe start doing those sooner rather than later.
Yeah. So this is quite important because, like you just said, it's basically planning for your future on behalf of your family. You want to put yourself in a position where you don't feel like all your hard work is going to be going to the tax man. A family that I've worked with recently used a trust to secure their assets early. And trusts are an effective vehicle. They not only reduce your future tax bill, but they can also give your children and other family members support sooner. And again, with the possible autumn budget changes, planning now is essential. So if you ever need a consultation or just want to bounce ideas or just know a little bit about what you should do in regards to your estate, you could always message or drop either Lorraine, Michael, and I an email, and we could always talk about what plans we could put forward for you.
So, strategies to reduce your net income. Net income determines access to the benefits that are available to you, like child benefit, tax-free childcare. And if you cross the threshold, you can end up losing valuable support with these. But if you can structure your salary smartly, then you can ensure that you still remain eligible. Tax-free childcare account, for those of you that aren't aware of it, is something that the government put in place to replace the childcare voucher scheme that was around a fair few years ago. It offers up to £2,000 per child per year. What you need to do is pay into a childcare account online with the government, and providing you pay in £2,000 every 3 months, they will give you up to £500 tax-free. Some families miss out on this. You need to have both partners earning £100,000 net or less. So in order to make sure that you still earn it, you need to make sure that your net income remains at that level every 3 months when they ask to reassess. Things that you can do are salary sacrifices, like into a pension, EV schemes, maybe cycle to work. This will reduce the taxable income without cutting your lifestyle benefits and ensure that you still remain eligible. But as I said, it gets reassessed every 3 months. The timing is quite critical. And if you act too late, then you could end up losing out. So, for example, one parent that is earning £120,000 a year, you could direct £20,000 into a pension. This will give you your tax-free allowance back as well with your salary, so that will save you tax. At the same time, you'd still be eligible to pay into the tax-free childcare account and make sure that you can access that as well as build in your retirement savings.
It's about balance, I think, isn't it, Lorraine? You know, just
definitely
choosing, and I'll talk about that in a minute as well, just choosing you know, what's the priority for you, and what might be a priority for one person is going to be different for someone else. So it's about having that honest conversation, I think.
Yeah, making sure that it works for all of you at the same time, so you can still access stuff.
Exactly. Family decision, I like to think of it.
Yeah, definitely.
So I'm going to talk a bit more about investing and building your wealth. You know, after you plan your tax, the tax and the sort of investing picture should be taken at the same time. You know, the decision. Again, it's one of those the balanced decisions that you should be making. And you want to grow your wealth, you want to make that money you've got work harder for you. I think still most people now, that when they're putting money into savings, they're putting most of that into cash, whether that's in an ISA, whether that's in a savings account or premium bonds. And just to point out to you that UK inflation has now been over the Bank of England's target rate, so they target below this 2% figure. It's been above that since May 2021, and with the current inflation rate 4.1%, it's not looking like it's going to come down to that level anytime soon. We're starting to see savings rates reduce now, and I think, frankly, the current figures, you're going to do well to find a savings rate above that 4.1% figure. So ideally, you're going to be wanting to invest some of those savings into some assets that are going to get you a better return than inflation. And here you've got to really balance the risk of investing. And there is, of course, always some risk depending on the type of investment. But of course, you know, with that reward that hopefully you're going to get over time. We always talk about doubling clients' money in a 10-year period. That's the target. So you look at that at about a 7 or 8% annualized return to get that double figure in 10 years. So some options to consider. You can look at somewhat safer choices, safer being, you know, a subjective word. Is it safer in terms of the tax you're paying or the risk you're taking? These can look like, you know, pensions, ISAs, investment bonds can provide steady income, growth, and security. And slightly more risky growth strategies such as property, shares, venture capital can offer higher returns, but also greater risk. And what a lot of people try and do is diversify across, you know, slightly more risky assets to build in a bit of resilience there. I always talk to my clients about having an emergency cash fund. So, you know, wherever you want to put that in the cash ISA, in premium bonds, or just in your current account, of somewhere between at least three months, ideally sort of six, sometimes more months of worth of your expenditure as being a good idea. So, you know, whatever happens, that money's going to be there if you need it. It's in cash. You're going to get some sort of return on that, whatever it is, and then the rest, depending on your attitude to life and risk and spending, you can look to invest that maybe as a regular amount or a lump sum for the future. And you don't have to have a specific goal in mind. It doesn't have to be retirement or school fees or whatever it is. It can just be a general pot of money that you might need in the future. But it's important that you're taking that decision yourself as well. And also, don't forget the costs of investing. Particularly things like property. There's additional costs. You look at what's happening in that space with the renter reform bill coming in next year. That's increasing regulation, increasing costs on landlords. And actually, yesterday, a report came out from a think tank that's closely linked to the government, and they suggested increasing income tax by 2%, but at the same time reducing employee national insurance contributions by 2%. Now, if you're an average employee, then that's not going to make a lot of difference to the amount of income tax you pay overall, including national insurance. But if you're getting some or all of your income from other sources, such as dividends or property income, you're now going to be taxed more on that because you're not paying national insurance contributions at the moment. So I would personally put money on that happening at the budget in a couple of months' time. So all these things are something to think about for the near future. So here we're talking about balancing those sort of costs and tax and risk of investing with the net returns. Net returns being the key point here, because if you're not investing really tax efficiently, you've got to think about paying things like capital gains tax, or the legislation around that's changed as well. Probably would change again. Who knows, at the next budget as well. To give you an example in action. A client can combine pension contributions with, say, buy-to-let investment. So you're gaining that optimal tax relief efficiency. That's, pensions are the most tax efficient way of savings for the future. Whilst you're already also getting some income from the rental side of things. I mean, that can be in things, other structures like investment bonds as well. But you're able to access that capital possibly more tax efficiently in the case of investment bonds than you are with other investments, and that's certainly what I help my clients do. And obviously ISAs as well. There are stocks and shares ISAs, not just cash. And you get that same tax benefit from those. Of course, the difference with a stocks and shares ISA is that you've already paid tax theoretically on the income you've got, whether it's, even if it's an inheritance, you might have been paid inheritance tax on that. So here you've got to balance another balancing act you've got of that tax efficiency with the ability to access the funds. I always talk to my clients about pensions, it being a good thing as well, that you can't access the funds immediately because you're going to need some of that cash in the future. State pension, okay, it's okay at the moment. You've got a triple lock. How long that lasts, I don't know. I'm 45 at the moment. I'm not planning on getting any state pension before the age of 70 because who knows what's going to happen between now and then. So in essence, the more money you've got for the future, the more choice you have as well. So moving on to cash flow management and managing family budgets. Even if you've got a high income, cash flow can feel tight if you don't manage it. And of course, costs can shift with life stages. And I like to always point out a little thing called lifestyle creep. And the definition of this is the unconscious increase in your spending that accompanies a rise in income. I've been doing this job for 8 years now, and prior to this, I was working in the city, having an employed role. I would get pay rises, and I would find that I would just spend the money. At that point, I wasn't really thinking too much about where the money was going. Wasn't probably saving enough. Yes, I had the company pension. But I wasn't making active decisions. And this is the reality of it, that if you're not making active decisions with what you're saving, how you're saving it, decisions are getting made for you, and generally they tend to be bad ones. So, you know, your tax efficiency isn't great. Perhaps you're spending money that you don't really need to spend. You know, I don't tell any of my clients you're spending too much, or you're not spending enough. Sometimes I tell them you're not spending enough when, you know, certainly when they're retired, and you know, they're going to be paying tax if they die without spending it. But you know, that shouldn't apply to you guys. So things to watch, what to watch. You know, nursery fees might end, for example. Children start school, but then you've got school uniforms, clubs, trips. These quickly add up. You might be returning to work after looking after your children. This can often mean reduced income, net income here, because you've got the higher childcare costs, of course, as well. And many families now with the baby boomer generation, the largest sort of cohort there is in the population, they're starting to sort of get older, getting more infirm, retire, etc. So you've got that sandwich generation challenge. So you've got to support your children and your parents as well. And you know, just coming back to that inheritance tax picture as well, pretty good time to be talking about this. I've had a few clients actually that have come to me. They're concerned with, you know, what's going on in the newspapers about wealth taxes, what's happening with inheritance tax. There's all sorts of things they're looking at. I think, frankly, the nation's finances are in probably a slightly more perilous state than we know. And you know, they're talking about, I think it's a 30 or 38 billion pound black hole they've got to fund at the next budget. So you know, they're going to have to find that money somewhere, unfortunately. And I think they've said they're not going to tax personal income and expenditure. They said that in the manifesto. So they're going to have to go over, you know, through these sort of ancillary taxes here. So to give you an example here, we've seen families use tools like Money Hub to help them track spending. It's a good idea quite often, particularly, you know, when nursery fees are ending, they can be prompted to reallocate money, say £300 a month, into, you know, other expenses, or even save that money. And therefore, you're keeping a balanced budget. You're not just spending money that you don't necessarily need to spend. You know, obviously it's your decision if you want to, but you know, it's better off you making that decision than not. And it's those conscious decisions that are really important here. I also wanted to talk a bit about protection and insurance, because this is something I find people quite often overlook. And I just wanted to pose the question to you: have you ever considered what would happen if illness, injury, or death were to hit you or your partner? And you know, what would happen to your savings and investments in this scenario? You know, we never know what's going to happen the next day, particularly if you've got children. You know, I've got a policy. I've got two daughters, they're 6 and 9. I've got a policy that if something to happen to me or my partner, it's a slightly different. It's a life insurance policy. But if something would happen to us, one of us died, that it would pay an income for a set amount of time, and that's the time period up to when my daughters get to 21. Of course, you can get lump sum, etc. You know, whatever sort of suits you best, whatever is more tax efficient or cost efficient for you.
Me and my husband have got something similar, actually, that we only did it when we had our 2 girls. And our one goes into a trust fund for them if one of us was to get sick as well. So I think it's really important, and it tends to be something you only seem to think about when you've had kids, I think.
Exactly, yeah. I mean, it was exactly the same for me. Yes, you might get coverage if you're employed through the pension scheme. What a lot of people don't know, actually, with that, just briefly, on a technical note, that money, if you're getting, it's generally a multiple of your salary, so it might be 3 times your salary, that will get paid into the pension scheme. So that can be subject to certain taxation through there as well. So it's these things are taxed slightly differently depending on the way they're structured, and you know, there could be some sort of unexpected you know, I'm sure everyone, will live a long and fruitful life, but you never know, and you want to make sure. I think, I personally did that. You've got every I dotted and T crossed. And it's not just about life insurance as well. What about something happens to you? What if you're not able to work, or what if you need some sort of serious treatment? Um, so you've got two different options here. You've got income protection, which will cover parts of your salary, because insurers won't cover your entire gross salary, because you're not going to be receiving your gross salary in your net pay anyway. You've got tax there, so generally they'll offer up to 70% of your gross pay as a sort of income if you're unable to work. So basically, if you're signed off of work by a doctor, they'll pay out after a sort of excess period for generally up to a couple of years. Most people, it's entirely up to you in terms of the way you perceive this risk. Most people will probably get back to work within a couple of years from a serious illness, something like a cancer, for example. Some people won't as well, and that's where I guess the sort of the critical illness cover comes in too, because that pays out a lump sum if you're diagnosed with a sort of any of the set conditions on the policy. People will use that cash to sort of help them get through that period. There's additional costs, not just the costs associated with not being able to work. It's the cost for trying to get better, that depending on whether or not you've got another one I'm increasingly looking at with clients is private medical insurance as well. Yes, maybe you get that through work, but it's the same thing with life insurance. You don't know how long you're going to be employed where you're at, how your health is going to be in future as well. So if you're buying your own policy, you're ensuring that sort of coverage is there no matter what happens with your work situation. And of course, if you're self-employed, you have to make these decisions yourself as well. And of course, coming back to that sort of perception and that idea of risk, that you've got to know what the cost of these things are to be able to make the decision. Is it worth? Do I perceive that it's worth me, paying a monthly amount, 50 quid, 20 quid, whatever it is a month to get this coverage? And it's that sort of peace of mind. How much do I value that peace of mind? Of course, you're not going to know until you know what these things cost. So yeah, I would say, if you've not sort of considered this, it's definitely worth getting a quote just to understand at least, how much it costs. And if you're healthy, if you're relatively young, and when I say relatively young, I mean sort of under the age of 50, these things are generally not particularly expensive. It might well be a lot cheaper than you think. So yeah, I mean, I've given a couple examples there already. So critical illness, one of the partners falls seriously ill, triggers the policy, you get a payout. Generally, people go for around sort of 100K coverage. Everyone's different. Everyone's expenditure habits are different. Their lifestyle is different. You can be the judge of what you think's gonna be a good sum for you. Of course, you don't know how long how ill you're going to be, how long it's going to take for you to get better. Hopefully, you do get better. And also, if you don't already know, it's a really good idea to check what the terms and conditions are of your employer. If you're employed, how much of your pay you're going to get. Generally, your employers will take out their own sort of internal policy to cover all of their employees, and that will pay out, maybe 6 months, a year of your salary, maybe longer. Definitely, if you don't know this already, reach out to your employer to check these things, because I'm telling you don't want to go onto statutory sick pay. That's £118.75 per week. So, this if you've got a young family is going to be a big issue. So I would definitely say, if you don't have this coverage, or if this is something that really concerns you, definitely take a look at this. And the other coverage as well is income protection cover. It's not a substitute for a critical illness, of course, because that pays out a lump sum, and you can how you budget is up to you, of course, but that's going to influence the amount of cover you take. Of course, it's going to influence how much the premium costs too. So on to shared tools and resources. Before we close, let's share some practical tools that you can start using today.
So for Planning, obviously, HMRC have a lot of calculators on their gov.uk website. You can check your tax codes, check your eligibility for things such as tax-free childcare, child benefit, stuff like that. Nordens have also got their own advisory tools and their own advisory team. So if you have any queries or questions, you can have a look on our website or get in touch with one of us and we can see where we can help you.
You've also got money management apps such as Emma, Snoop, Chirp, and Money Hubs, and they help you connect all your bank accounts. So they show you your spending habits and spending patterns. Some of us have subscriptions, like myself. I think I had 2 Netflix subscriptions coming out of my account. So it kind of just highlights where you're spending unnecessarily. Also with Chirp, Chip does this thing where if you've maybe gone to buy a coffee for £2.50, you could set that it rounds up to the nearest pound and help you save that 50p in another pot. I have that as well with my bank account, actually. So sometimes when I log into my online app, I feel like I've got some money stashed away somewhere, but essentially I'm kind of saving in a little corner.
I like the sound of that. So it rounds up everything that you spend and pops it somewhere else. So you can't touch
Literally.
it, or
So you can touch
No.
it if you go there, but
Yeah.
you kind of forget about it because you're mostly looking at your current account or looking at one of the
Yeah.
savings account that you sometimes transfer from, but you're not essentially looking at that particular account. So it's like a pot that you've kind of hidden away in a corner, which is nice.
Definitely.
And then there's also the credit building tools that I think a few of us don't really know about, or maybe we're too scared to look at our credit rating. But tools such as Lockbox, they help you keep track on your credit rating, yes, but also how to improve your credit rating for free. They do also have paid options where you could I think it's like $2.99 or $3.99. Don't quote me, but it's a small fee just to help you increase your credit rating in the long run. So if you've got like maybe a mortgage that you're looking to, a property that you're looking to invest in, so you need your credit rating to be a specific amount for mortgage, or you want to buy a car, or you want to do something investment wise, it will help you in the long run.
So in terms of the investing, we've got a couple of one of the largest providers, Vanguard there, and Nutmeg. These are obviously platforms that you can sign up to yourself via an app or on the internet. They'll give you generic sort of investment options. Generally, these options will be something around it will try and ascertain your individual attitude to risk. It will just give you generalized questions. It will recommend some general portfolio. Generally, that will be something like a global portfolio of equity investments. If you think that at the moment the US markets, so the US Standard & Poor's, NASDAQ markets, they comprise 70% of all the value of all the companies in the world. So a lot of your money in those cases, if you're just going for a global equity fund, that will be going into the US. Is that something you want at the moment? Is that going to be the right sort of thing for you? I would personally don't think it is, given what's going on in the US at the moment. You know, for example, the US dollar in terms of the pound. So this is something I find quite often with clients actually, that when they're investing in assets, certainly abroad, that they don't realize that there's a thing called currency risk, which means that even if those assets are sort of going up at maybe 10-15% a year, you've got exposure to the currency. So in terms of the dollar, in this case, the dollar is down about 12-13% this year, so year to date. So the markets, okay, they're up about 12-13%. So effectively, as we're all in the UK, we spend money in pounds. Unless we're going to go to emigrate to the US, and then we're spending dollars. We have to consider the value of our investment is going to be impacted by those things as well. So, what I'm trying to get at here is that these platforms are giving you, very generalistic options to invest in, and so the other option here is to, work with someone like me that can tailor an investment portfolio specifically for you, work with you in terms of if you have an accountant, proactively to minimize the tax you're paying as well, and make that sort of right for you as well. So thank you, Lorraine, and thank you, Elizabeth. And of course, thank you all for joining us today. We've covered a lot of ground, from tax planning and reducing net income to investments, family cash flow and protection. If there's one key message, I think it's this: being a high earner isn't just about how much comes in, it's how well you manage it. And I don't know if we wanted to do the questions now, if we're going to do them after we've finished. So what do you think?
We can see if
do
we've got any
some now.
questions coming in.
There's quite a few here. I think quite a lot that I can answer. So David Wainwright is asking, are there any indications that there may be changes to the allowance for ISAs in the upcoming budget in November? I can answer this, but if either one of you want to have a go.
No, that's
So
fine.
yeah, so obviously each person, so if you're husband and wife, you get 2 allowances of 20k. You can put up to 20k into an ISA. There was some intimation that the government were going to reduce the cash ISA allowance to 5k a year. This seems to have gone quiet, so it sounds like they aren't going to do that. The reason for them looking to do that was that they wanted to get more people investing into stocks and shares ISAs, particularly UK companies, so they could boost the UK market. Also and boost people's future savings, because historically, there's no guarantee in the future, but historically, to get the best long run return for your investment, you have to take risk. You have to invest them in some level of stocks and shares or other assets that are risky. So at the moment, they're not looking to change that. I would say it's unlikely they are, and the only thing they will do is reduce the cash ISA allowance limit, if they do, probably. So we're looking at BlackRock here. So Stuart Seabrook, BlackRock and other wealth asset managers are saying individuals should invest at least 2 to 3% portfolios to Bitcoin. So I think probably me again. So Bitcoin and crypto assets at the moment, you're still not allowed to use ISAs and sort of government sponsorship schemes like pensions to invest in crypto assets. That looks like it's changing, because the UK is one of the few places in the world where you're not allowed to do that. In the US, for example, President Trump has just allowed US citizens to do this. So it's coming. I don't know when it's coming. I mean, there are ways of doing it. You can buy, there's listed companies. You can buy MicroStrategy is one of them that basically buy their companies that buy Bitcoin. So you can still get access to Bitcoin exposure at the moment if you want to, but that's I guess a lot more specialized. I think this is probably going to come in the new year. In terms of the FCA, the Financial Conduct Authority, allowing individual investors to invest in UK sponsored wrappers, investment wrappers we call them, so ISAs and pensions basically. My personal opinion on crypto assets depends on the crypto assets. I mean, the big one is Bitcoin, of course. Ethereum's another big one. And I tend to look at them as basically digital gold. I think gold and silver, you might have seen in the press, gold and silver are both at record highs now. And it's a similar thing with crypto assets. So basically, why are they so high? Well, people are seeing that, I talked about inflation earlier. People are seeing the level of inflation we've got. The expectation for future inflation is going to remain high. I personally think we're probably looking at in the 3 to 4% inflation range for the next few years at least, that being normal. So where that happens and where interest rates are going down at the same time, I think we'll start seeing that as economies maybe aren't as strong as people think they might be at the moment. The money you're going to be getting on cash on return is going to be lowering. So these types of assets might well be boosted over the next few years. So yeah, I mean, you can get gold and silver ETFs, for example, in investing terms. So if you're desperate to do something alternative, not the kind of traditional stocks and shares and bonds within an investment portfolio, that's something you can look at as well. So we've got Elizabeth. Yeah, okay, you've answered that one as well. Do you think these reductions come into effect in November or April? I think generally it's going to be April for these sorts of things, because it's going to cause too much too many problems. I mean, maybe they'll do them straight away. Capital gains tax changes they tend to make straight away because people, starts distorting what people, the assets people buy and sell. Income tax always generally tends to be done from, April, because it just causes too many issues for accountants and people. I don't know what what you think on that one.
Yeah, April. Sorry, I think Lorraine was about to say something.
No, that's fine. Yeah, I think anything that has an immediate impact on what people do, I think would potentially come in sooner than April. But I think given that a lot of it may be negative, it may be deferred slightly.
Miranda Barnum, how are you structuring an investment portfolio to double in a 10-year period? So for it to double in a 10-year period, you're going to want a higher exposure to higher growth assets. So, stocks and shares. That portfolio, as I said, historically, the last 10 years, if you put most of that in the US, you're going to achieve that. And conversely, I think, this is my opinion, in the next 10 years, you need to look outside of the US and probably outside of Europe to get that kind of growth level. So you're going to have to take more risk. But if your time horizon is very long, the risk is manageable. Say, for example, in a pension, you can't access that money for maybe 10, 20 years. So you're okay with taking that higher risk in that longer run period. Generally, speaking, in the long term, the higher risk you take, the higher rewards you get over over a larger length of time. There's no guarantees, of course, with anything, but yeah, it's that risk kind of balance thing again there. Are you still advocating for investing in buy-to-let property, given that capital gains from property investment has tailed off so significantly, and given the high interest rates? Yep. So I guess I'll just give my thoughts on this quickly, and you guys can chirp in or give your thoughts after. So I think, yep, capital gains is what, 24, isn't it? I think it's 24% for property. I don't think that's going to go up anymore because people just won't sell. What I'm seeing with my clients that have property investments, they're not big buy-to-let landlords. They might have one or two properties. They're probably waiting for their fixed rate mortgage to end because they probably got that in the last 5 years when rates were next to nothing. Depending on the relationship they've got with the tenants. Some of them have got out already. Some, with the inheritance tax picture, they're gifting to children. Some children don't want them because they're already on a high income. They don't want the rental income to, they're paying 45% rate of tax, for example, on additional income. They don't want it. So they're selling and then maybe looking at doing some sort of investment for the children, junior ISAs, making additional investments to their pension, that sort of thing. I think in terms of the yields, yes, rental rates are up. I think there's a limit to how high they can go. Certainly, with you look at the immigration picture in this country, it's still high-ish, but it's it was sort of a million people coming in a couple of years ago, and that was putting more pressure on the rental market. I think that's going to sort of reduce a bit. Mortgage rates, I think, will probably start moderating. I don't see them going up, but it's too difficult to predict. But again, it's that risk picture as well. I definitely think tax rates are going up, like I said. It's these sort of little things. The big one on this is the renter reform bill, which looks like it's coming in early next year, and effectively that gives a hell of a lot more power to the tenants certainly in terms of landlords trying to get people out. So I would say that's probably going to put if you've got, I don't know, less than 5 properties, it's probably not going to be worth doing in the future, really. Some people like doing it. I think property prices are going to keep going up. But is that enough for you? Are you going to get enough there? Certainly, maybe you might even be losing money on an ongoing basis with the tax, with the costs, etc., of letting that property out. So, yeah. How about you guys?
Go on,
I think a lot
Elizabeth.
of I do, just to add on when it comes to, say, rental properties, a lot of people don't know that they could also use or utilize things like deed of trust. So, for example, you might have a partner or somebody else that that you're with that you would like to share that income with, so it doesn't affect you too much income tax wise. So there's always looking how we can make you look more tax efficient in the long run for the tax year. Maybe if you split the rental income by 50-50 or by, I don't know, 80-20, just kind of depends on what the income looks like for the higher earner, between the higher earner and the other earner, in a couple or in a partnership. And then, of course, there's, if you have a couple of rental properties in your personal name, you could always consider putting them in a company, and utilizing, you know, the company tax rates, so that it doesn't affect you on the personal level as well. Because like Michael said earlier, you've got the additional tax rate ban, which is 45%, whereas if it was rental properties within the company, you could utilize the 19% rate ban, or even up to, and then of course, when you are above the 50,000 pound mark, then the tax rates does increase slightly, but it's still very much lower than the income tax rate. So there's always that that we could look into.
You've got to get the property in the company, though, haven't you? So you might have to pay stamp duty if it's not already in the company in that case, right?
Yes, however, there are different ways that we could always get clearances from HMRC, to mitigate those when you're transferring the property into a company. But it's always bespoke, so it just depends on the individual and what circumstance they're currently in, and how we could best utilize their circumstance so that they have the better end product or end tax.
It's definitely something that's coming up a lot more these days, I'm finding. People looking to move them in, and do it that way. Sometimes even incurring the cost of the stamp duty and stuff will be small in terms of the long-term saving with regards to tax. So in the long run, it actually could work out to be a better option for sure.
I think where it makes the most sense is if you're legacy building. So if you want to pass this on to
Yeah.
your children, you know, you can put it in their name and they get the income. I think that's it does make sense there. But you know, again, then you need to sort of assess what's the other options, right? I mean, is this the best option from a, you know, multiple perspective? I think ultimately what comes down to, some people just love property and they're never going to not love investing in property. So there is that. So Miranda Barnum, my mother lives in Australia where they don't have inheritance tax. As I understand, I won't have to pay inheritance tax here as the estate is in Australia. Do you think there could be rule changes which could see me liable for tax when I inherit her estate? Can I have a go at that one?
With the UK, anything can happen, I always say. Immediately off the bat, right now, there is no tax to pay. The inheritance tax, if there were any, would have been paid in Australia before your inheritance comes towards you. So any inheritance that you have is literally yours. In terms of the changes that's currently happening, safe to say that we don't know what's going to happen. Anything could happen, like in a game of football. So we just have to wait and see. But right now, there is no tax, no.
Yeah, so we've got a double taxation treaty with, I'm sure we have with Australia, right? So that means you don't pay the same tax twice in both locations. And when if you were, for example, to bring the money in cash into UK, then you just bring it in cash. So yeah, there's no sort of tax to pay on that. But I think that the other point to note as well is if you're inheriting like assets like property, for example, then you know you're inheriting that from whatever date, and then if you were to sell that in the future, you might have capital gains tax on that, of course. So you need to think about those things as well. So you might want to sort of put everything in cash and do something a bit more creative with it. But yeah, there is that to sort of think of as well. And when I looked into income protection, it was very expensive and not really worth it. When is it worth considering? Well, I mean, everyone's different. So, some people have health conditions. Everyone's different ages. There's lots of factors that go into the price of. You can tailor with income protection. You can tailor the length of time that it will pay out for example. So you can say I want it to pay out for 2 years, not 5, and that will reduce the price. Or you can look at maybe reducing the amount of cover you need. So instead of going, for example, 70% of your salary, you can go for 50%. So that will reduce the amount you pay. It's always that sort of, do I see the value in paying X amount to cover this risk? And everyone's different. But, the point I was trying to make earlier is that if you don't know how much it costs in your circumstances, you're not going to be able to make that decision. And the fundamental fact here is that the longer you leave it, the older you get. So life insurance companies in particular, they look at your birthday. So whenever your birthday happens, then you kind of go up to another level of expense in terms of the coverage. So doing it sooner rather than later is definitely the best thing.
I think also with that, it's worth looking at it. If it is something that you are seriously considering, but you think about the cost, it might be worth making some of those tweaks that you were mentioning, the type of cover it is, the amount of coverage that you're going to get, just to kind of see if you could bring it down to something that's a little bit more manageable cost-wise, but you will still get some sort of protection. I think it can be quite important, especially if you've got, mortgages, children, things like that you need to rely on. Obviously, it's like any other type of insurance. You don't know you need it until you need it. But, to have it there in the background I think could be quite important. But yeah, it depends on how important it is to you. But if it is something, then it may be worth looking at juggling some of the different variables to bring it down so that it is something you could manage to have.
Yep, definitely. Definitely agree with that. So I found it hard to get. Hang on. I found it hard to get info from AXA and Bupa on private health insurance. Is one better, hard to compare? Well, I mean, generally, with the private health insurance, there's different levels of cover that different providers offer, and that generally tends to be around the types of hospitals you can go to. So the premium hospitals are the ones generally in London. Otherwise, you're going to have to be looking outside London. Of course, this depends on where you live. The coverages aren't massively different, but that's again where you're going to want to. Maybe it's better off getting a bit of professional advice. Someone, I do this, for example, where you can look at the different coverages and these can be highlighted to you. But generally speaking, they're not massively different unless you're selecting a different level of coverage with each insurer. I'm sorry I missed the beginning of the webinar and intros. This is from Jenna. We've always gone through our accountant for tax rates. Okay, so that one's fine. We also need to plan for the future. So I think our details are in the chat, aren't they, earlier?
Yeah, at the top of the chat.
Put them again, maybe, for those that came later. Question is it worth having a property with a large equity and all the hassles of being a landlord and worse, being ever more regarded as a social pariah with this government? And that just means landlords will get punished more and more, right? Do you want to go at that first? Anyone? Or I can take this one.
Yeah, so, I think. Oh, go on. No, you go.
So, thing with property investing is historically it's been very good because the tax treatment was a lot better than it is now, of course, but it was mainly the ability to leverage. So you borrow, you put down 10-20%, you buy the house, of course you rent it, get the income. But it's that leveraging. So, you'll say the house is 100,000. So you're putting 10,000 pound deposit. So the amount that you're investing is £10,000. Yet because of the leverage, you're borrowing 90,000. The rental income pays for the mortgage payment, the interest on that, etc. Because you're that leverage, when that house goes up, maybe in say 10 years' time, and goes up to 200,000. So your gain is 100k. So your gain on your initial investment of 10,000 is 100,000. So that's 10 times. Versus if you own that outright, so you just buy a thing in cash, your gain is still 100k, but it's not 10 times, it's 2 times. So if you've got more, the point here is that if you've got more cash in your property, the return on your investment is worse. A lot of people don't bear that in mind when they're property investing. Of course, if you have a property for a long period of time, you might be paying off that mortgage. So in a way, your capital gain, the rate your capital gain is growing at, is actually declining because you're paying off that principal as well. Because for me, when I'm looking at investment decisions with clients, it's okay. You've got X amount of money. Let's look at the tax efficiency point of view. Let's look at the potential return. There's no guarantees with that, as there isn't in the growth of a property, for example. But then you're looking at the net gain after, and I use cash flow modeling software with my clients as well, which is where we look at all their circumstances, put that into a model, and that will model the future return on those assets, the future taxation, the future income tax, the current income, all these things. And it will give you a picture of the future. So we can run scenarios, say, oh, I want to invest in a property here, or I want to invest in an ISA or pensions or whatever it is. And we can show, yes, there's assumed growth rates. We'll tell you what those assumed growth rates are, but we can see exactly, what that sort of looks like. But, it's a theory. There's no guarantees here, but it gives you a better picture of what that might look like. So yeah, I think it's safe to say that most people are sort of looking away from property. But the big one for me, as I said before, is that renter reform bill that's coming in next year. That's going to be humongous, and I just don't think a lot of people are particularly aware of what that actually means. For example, if you want to get someone out of your house, your property to sell it, you need to give them a year's notice. Whereas now at the moment it's 2 months via Section 21. So things like that is it's going to make a big difference. I think going forward. And I think just my chat wasn't working on phone question. Yes, property long-term investment. AI is going to be something people need to be very aware of. This is going to make the world very different in 5-10 years. Absolutely, totally agree. I think Bill Gates said that AI is going to change the world a lot more than people are thinking in 10 years' time, but a lot less than people are imagining in 2 years' time. And I've got a friend of mine who's an entrepreneur, and he thinks, I think he's been a bit extreme here, but he thinks we've got 5 years to make as much money as we can before the sort of robots and AI take over. Everyone's got their view on this, but yeah, definitely the world's going to change in ways we probably can't perceive at the moment. And what does that mean? It's a good question in terms of what does that mean for tax as well. Are we going to tax robots, for example? Are we going to be getting some sort of universal basic income? Who knows? I mean, it's nothing's off the table really at the moment. And some people think that technological change is going to be bigger than the what happened in the Industrial Revolution. Who knows? Thoughts? Anyone?
Who knows?
Yeah,
it moves so quickly, I think.
Yeah, exactly. Anyway, so yeah, Elizabeth, do you want to
I'm conscious of time
continue?
now that we've gone over. Yeah. And yeah, I'll just like to add that, of course, taking practical steps, whether it's using allowances or contributing to pensions or simply restructuring income, can make a real life difference. It's about, like I said in the beginning, being proactive and not reactive.
Yeah, that's exactly it. I think the families that we work with often say the same thing. On paper, they might earn well, yet with all the school fees, childcare costs, rising costs, and tax thresholds, it quickly gets eaten away. So at least with some planning, those pressures can be managed, and some sort of peace of mind can be restored.
Right, so before we close, I'd like to thank Karen, our marketing assistant, who's been working hard behind the scenes, getting everything ready. She'll be sending out today's slides and recording to everyone who attended, and to those who registered but couldn't make it.
And finally, if today has sparked any questions or ideas that you might have, please get in touch with us here at Nordens. We're here to help you and your family put the right structures in place, whether you're employed, self-employed, or running a business. So thank you once again for your time, and we look forward to supporting you in the future, and we hope to see you at our next session.
Thank you.
Thank you.
Thanks, guys.